Neelkanth Mishra, MD, Co-Head of Equity Strategy, Asia Pacific and India Equity Strategist at Credit Suisse, on the show with us. Neelkanth, hi, good morning. Good to have you on the show. Neelkanth, I can't resist, but I have to talk about the tech sell-off that we've seen overnight. I mean, Facebook losing 26%, its biggest ever sell-off. Mark Zuckerberg is not in the top 10 list of the richest people on planet Earth anymore. What's going on? I mean, are these stocks falling under their own weight in the recent sell-off that we've seen with the technology universe? Or do you sense that these companies, which are big fad plays on social media, if I can call it that, in this ever-changing world of technology where you now have Metaverse, which it clearly inspired Zuckerberg to change the name from Facebook to Meta. I mean, when I know my colleagues themselves are hooked on to the world of Oculus, so we're living in this AR world, so to speak. Do you think these tech giants are somewhere now going to have to re-strategize as to how to build in those growth numbers going forward? And eventually, it's the one with the deepest pockets which is going to win the race, perhaps?
Yeah, so it's. I think so. You answered the question. There is the next leg of technology transition, right? So short videos are taking a lot more share in terms of viewer time, and therefore the engagement levels, and therefore the ad rates that you can get, and therefore revenues are starting to fall. I think some companies. I'll not talk about company-specific stuff. I'm not authorized to. But there are companies that are now starting to lose subscribers or other, monthly active users on their apps. And so this is a technology transition which I think has been imminent. Some of these companies, the very reason that they have been re-strategizing was perhaps they could see it coming. And I think the market is now woken up to them. But at the same time, there are other tech companies which are still holding on, which have reported very strong numbers. So I must say that this transition is something that I think the market has woken up to now. And this is perhaps compounded by the uncertainty around interest rates. See, if you have 0% interest rates, it does not matter whether you make money today or tomorrow or 5 years later. But if the interest rates and real interest rates start to move up, then the question comes as to if there is uncertainty for the outlook over the next 5 or 10 years, then the market starts to panic. We are seeing some of that in the Indian space as well. So as US bond yields have gone up, some of the new tech listings have seen a very sharp sell-off. So now they have to prove that they can actually generate profits, and that's what the market will trade on. So it's, I think, a blend of both of these things, a technology transition. So we have seen like Yahoo was a very big success, and then because it could not keep pace with the pace of a change of technology, it then slided down, and it's a fast changing world. And the second issue is, as we discussed, the interest rates, which have changed.
I'll come to that point on interest rates in just a bit, Neelkanth. But I'm just looking at and drawing a comparison with tech stocks back home, for instance. Meta and Instagram is not the same as TCS, and an Alphabet is surely different from Infosys. I understand the knee-jerk correlation, and I understand that these stocks could be falling under their own weight. But are we looking at a long-drawn patch of perhaps time-wise consolidation / correction with the Indian IT sector as well back home? Or would you say that after this knee-jerk reaction plays out, it's going to perhaps restrict itself to the new age tech companies, the newly listed universe, the IPO stocks?
So the second part, or the second argument that we gave for the second argument we gave for the sell-off is something that applies to the Indian IT space. So if you measure the Z score, or rather how many standard deviations above they are in terms of their average PE, the IT space was the most expensive, and which is why we were underweight the sector. And I don't think it is about the sell-off in Nasdaq, which is affecting the Indian. I mean, there may be some minor links, but I think this is just related to the fact that the sector had seen a lot of momentum, which had pushed it up to price to earnings levels, which were perhaps unsustainable. And now it's seeing a correction on that. And we've been writing a lot on software. So we wrote last year about how the need to write software and the need for software engineers in India was going up very sharply. But a lot of it was happening outside the Indian IT services companies. It was in SaaS companies, which can generate $80,000 to $100,000 per person. An offshore IT engineer can generate $35,000, $40,000 per person. And therefore, the ability that a global IT major or a software as a service company or a tech startup or even captive centers of large banks like ours can pay is, of course, substantially higher than what an IT services company can pay, and that their margins and their churn would get affected. So some of that, I think, remains an overhang. The world will need more software over the next 10 years. There are very few places other than India where you can get those engineers. And so the demand for engineers perhaps may outpace the demand for the IT services firm. So this has been a concern for us. But some of the sell-off that we have seen is just a sell-off of high price to earnings names.
We've been talking about PE compression here, in fact, Neelkanth Mishra, good morning. And that's something else to talk about. It's not just in the tech space, right? Now, there are two schools of thought. You can have a situation where it looks expensive now, but 2 years, 3 years down the line, it may not look expensive. Is there a readjustment which is taking place of what is considered to be fair value? And I don't mean just for IT. This could be for FMCG. It could maybe one day even be going forward for the value stocks.
Totally. So this is where interest rates and the discount rate starts to matter, right? So if you're of the view that it does not make a difference whether the company is making profit today, 3-4 years down the line, so long as it can grow, and therefore companies are evaluated and are still being evaluated on how fast they can grow, how fast they can build scale, and how much metal or pedal to the metal kind of investment they're doing. So basically, when they incur losses or they need persistent inflows of cash, so those assumptions start to change when your assumptions on what US rates are going to be are starting to get modified. So to take a step back, 2 years back, it was very difficult for everyone, and including, so I do not want to criticize policymakers, but every country had to decide how much of monetary and fiscal stimulus to give, because clearly there was going to be a recession because lockdowns were being imposed. How much should you give? In hindsight, now we can go and see whether too much was delivered or too little. In most economies, in the developed economies in particular, which did a lot of money printing, you see there has been a sharp surge in the cash being deposited back overnight with the central bank. So the banks are treating, so in the US, it is $1.5 to $2 trillion. In Europe, it has gone up to $4 trillion. Japan, some people say, has always been high. It's been about $4 trillion, which means that too much money was printed. On the fiscal side, if you track retail sales, in almost every major economy other than the US, the retail sales are at trend or slightly below it. In the US, they had gone up to 10, 11% above trend. These are 6, 7 standard deviation events, which should not have happened, which means that too much stimulus was delivered. And therefore, what regulators are now, with the benefit of hindsight, now realizing is that they need to wind it down. And as that wind down happens, the markets are in a very different place than they were in the last 10, 15 years, in the sense that at every whiff of weakness, the expectation was that the Fed or the US government or some large central bank would come and print money and will bail us out. Right now, you have a situation where the demand numbers are starting to fall, but the policymakers are busy fighting inflation because they are now busy unwinding what they did 2 years back or over the last 2 years. And I think the markets are not really anchored to that. So as this happens, uncertainty about the future goes up, and that's bad for PE multiples. So when you are very certain about what's going to happen, which is why consumer staples and some of the healthcare names trade at such high multiples, because you have a reasonable visibility on what the earnings will be 3 years, 4 years, 5 years out. You can't have that for metals, or you can't have that for oil, and which is why those stocks trade at lower multiples. So when there is greater uncertainty on what may happen over the next 2-3 years, it is natural to see high P stocks starting to come off.
Okay, so let's see how all of this pans out. And the jury has still been divided on which way and how to exactly trade the metal story. But Neelkanth, because we have you with us, what I would love to hear from you as well is the divergence of sorts that we've seen in the equity markets and the bond markets. How do you see that come off at a time when our government is also talking of substantially higher borrowing program, the interest rate hike, which is going to be impending across the globe? We don't know when it's going to happen, but it's a question of how much, and sooner than later, even if it doesn't happen in India on the 9th of February. I just want to understand how are you going to juxtapose it all together, what we're seeing in the bond markets and the equity markets?
Yes, so a great question. I think in the Indian bond markets, I think we now need to start paying attention to the underlying trends, right? So state and central governments are sitting on 5.5 trillion rupees of cash, and I think how the cash inflow is happening, how the tax collection is improving, and how difficult it is to ramp up spending when you're sitting in the government, and especially if you've lost several months because of lockdowns. That cash balance, I think, will keep expanding. My expectation is that sometime during the next fiscal year, most likely around the time when the second half borrowing calendar is being finalized, I think the governments will need to dial down on how much borrowing they need to do. And that, I think, will be a relief, because what we are seeing right now in the bond markets is, I think, a premature tightening of conditions. So the term premium, whether we can keep debating whether 70-80 basis points is the normal term premium, which I think should be the case, versus some people thinking it should be 150. But whatever be the case, 290 basis points is not the right level of term premium. And even if you assume there is some amount of tightening which has already happened, so it is, I think, a mistake to assume that monetary conditions in India have not tightened. When you have overnight liquidity surpluses, the effective rate is the reverse repo rate, not the repo rate. And the reverse repo rate, which was at 3.35 because of VRRR, has already moved to 4%. Right? In a normal case, if repo was 4, reverse repo would have been, the normal window is about 25 basis points. So we've already seen a 25 basis point tightening over and above, the narrowing of the window. And this is reflected in deposit rates rising. This is reflected in 10-year bond yields being 60 basis points higher than they were pre-pandemic. And we have to now think about whether we have prematurely tightened. And as you see more evidence coming through that the cash balance keeps rising, I think the state and central governments, as well as the bond markets, will recalibrate what crowding out is actually happening. On the equity side, I think the decisions in the budget were actually quite constructive, because what the budget showed was that the government was focusing on sustainable and medium-term growth, and not necessarily in distributing cash and supporting growth in the near term. And as equity markets discount longer-term trends, I think this is actually supportive, and which is why I think the equity markets have generally done better. My concern about our markets over the next year is more global than local. I think the domestic economy is doing fine. I think it is the global uncertainties, which we discussed earlier in our conversation, that worry me a lot.
So Neelkanth, morning then, would you believe that this elevated uncertainty in the US would lead to more FII selling, despite the fact that you said that the macro situation back home continues to remain robust? Or do you think that we will see a shift in stance?
FIIs have actually, I mean, other than a 2-3 month period in October, November of 2020, they've generally been, very passive participants in the domestic market, in the Indian equity market. I don't think too much more of a sell-off is necessary. I think a lot of the calibration or recalibration that needed to happen for US monetary tightening. See, the thing is also in the US, you are likely to see inflation, the drivers of inflation shifting from goods to services. And goods inflation is transmissible. It actually shifts, it's very, because goods are traded. You cannot have higher steel prices in the US and lower steel prices in India or China. But services inflation, which I think it is starting to shift to, and which is what is worrying the US Fed and the US government, is less transmissible, right? So a taxi ride or a restaurant meal in the US becoming more expensive does not mean that inflation will transmit. And I think as some of those trends, start to become more obvious, you will see the domestic equity market becoming more attractive. The challenge I see is that the India price to earnings premium to world. So for FIIs, one very good anchor is if the price to earnings premium is at a record high or near the top of its 15-year, 10-year range, then it needs to, so as the global markets fall, then India will come off as well. Will there be aggressive further selling of EMs? I suspect not. So a lot of the selling we have seen here is actually EM related selling, that at emerging markets in general, higher rates in the US are considered very bad for them. But I think a large part of that is done. But the excessive premium that exists right now, India versus EMs and India versus world, is something that worries me. So if the world equities, global equities correct, then they will drag down India as well.
And what about the kind of budgetary allocation towards infrastructure, particularly in spending on roads, railways, defense? How have you read into the kind of prospects that were doled out and the kind of very capex heavy budget announcement?
No, that's actually a very clear signal of intent, as I said earlier, that the government wants to focus on sustainable growth. The government wants to focus on productive spending. See, in democracies and in general, when people comment on the powers of the state, this monopoly on violence, the temptation to spend other people's money is very strong, right? So if you're sitting in power and there are taxpayers who are sending you money, and then you decide, I want to spend here, spend it. But the fact that the government is being very disciplined, I think, is a very positive message, and which is why the longer term growth potential then improves, and that's why the markets loved it. In terms of actual spending, I think that the narrative for budgets and for what we should expect from the government needs to shift. I think it has already shifted, but I think the markets need to start focusing on that a lot more. Over the past decade, the focus used to be on how quickly can the government consolidate, because what the government had done was in 2008-9, it had delivered a massive stimulus, mostly in the form of substantial hikes to salaries of government employees. That is like a permanent stimulus. It is very hard to wind down. It took almost a decade for it to wind down. And so the narrative used to be how quickly can they consolidate. And it was very hard to consolidate. If your salary and pension bill goes up by 3% of GDP, it's very hard to bring it down. The challenge right now is how much can the government spend? So your tax to GDP is going up. Your market expectation of how much you can borrow is elevated. They still got a bit surprised. And I think the bond index inclusion progress not happening was perhaps a concern for the markets as well. But by and large, I think a 6% kind of deficit for the center was very much expected, which means that now you have space to spend. Now, the question is, can you spend? And once you remove that 1 lakh crore low interest loan or zero interest loan for 50 years that has been promised, that if the states have a credible plan to spend and they can spend fast, and that 1 trillion rupees, 1 lakh crores will be allocated. If you remove that, the growth is incremental. It is not substantial in the sense that you're seeing about 30,000-40,000 crore increase in roads and railways spending, which is not a small sum of money, but in an economy which is going to be 260 trillion rupees, 300-400 billion rupee extra allocation. I mean, if you add Nal Se Jal and defense, maybe it is 60,000 crores or 0.6 trillion. So in a 260 trillion economy, a 0.6 trillion extra expenditure is good and shows great intent, but I don't think it is meaningfully adding to aggregate demand. And this in many ways shows the challenge that the government has to face now, because it has to now recalibrate from being in a tightening mode, which it was for the last 10 years, to figuring out how to spend in a way which can be dialed back if they see that the economy is doing well. So it is a challenge. And I think this will take some quarters to solve. And as that plays out, we will see the need for borrowing to fall. And that may happen by August, September, when the second half borrowing calendar is being set.
Okay, so let's see what really happens. Another very big trigger for our markets will, of course, be on 9th of February, when we know the outcome of the RBI Monetary Policy Committee meeting. It does seem that after, in the budget, whether it's brave or they got bang on target, they're figuring inflation at 5%. The belief being that, what we are seeing is actually a commodity price run up, which should get corrected as soon as global supply situation is figured out, as well as liquidity is tightened worldwide. It's always a pleasure having you. Thank you so much for joining us live today, right here on this edition of The Market.